I'm Tracy Alloway. I'm executive editor of Bloomberg Markets, which means I spend all day thinking about exactly what we will be discussing on this panel. In other words, I think about capital flows. I think about the rise of asset management. I think about liquidity issues. Who doesn't, right? Everyone worries about liquidity nowadays. Even my mother has asked me about it, which is frightening. And we are going to somehow thread the needle through all those things on our topic today. We are talking about the age of asset management, the changing balance of power between banks and large asset managers, what that means for the overall financial system. And I have an excellent group of panelists here. I'm going to briefly introduce them, and then we will jump right in. So let's start down here. We have Nouriel Roubini, who is, of course, chairman of Roubini Global Economics and a professor of economics at the Stern School of Business, followed by Ronald O'Hanley. He is president and CEO of State Street Global Advisors. And we have Hilda Ochoa Brillenberg. She is founder and chairman of Strategic Investment Group. She was also a former investment officer for the World Bank. And then to my right, we have Jim McCaughan. He is CEO of Principal Global Advisors. And finally, we have David Hunt. He is president and CEO of Prudential Global Investment Management, otherwise known as PGIM. So just to set the scene a little bit, it seems like after the financial crisis, we saw central banks around the world come in and essentially flood the system with liquidity. And yet capital flows, the actual flow of money, has declined tremendously from something like $6.1 trillion in 2007 to $3.26 trillion in 2013. Why is that? Ron, I'm going to start with you.
Well, I think there are a couple things that have gone on during this time, but the biggest one, if you think about the period that we're talking about, is you had banks that were in the center of a lot of these capital flows basically being re-regulated and not having the ability, the wherewithal, or even the desire to participate in that. But the number, just to be clear, that you're quoting there, you've seen actually a shift. At the same time that you've seen banks withdraw, you've seen direct investment go up, and you've seen basically securitization of debt and debt markets open up, so therefore asset managers stepping in behind it, but at a much lower level.
A change in the composition of cross-border flows, in other words. David, I want to bring you in here. Have you seen a similar change in the composition?
You know, we have, and I think we haven't found it, though, particularly surprising. I was surprised somewhat yesterday at the number of commentaries around the fact that we had a recession in 07 and 08. Ladies and gentlemen, we did not have a recession or classic business cycle decline. We had a massive deleveraging, a global deleveraging that really only happens once every 20 or 30 years. If you go back, probably the best recent example was what happened in Japan, and even that was somewhat more muted. So what you would expect in an environment like this is to have an enormous amount of leverage come out of the system. And almost regardless of what happened with regulation, we would expect the leverage, which was primarily concentrated in the financial sector, to be pulled back. And indeed, it has been. We don't expect that to continue. And that is a profound implication, I think, for all of us, because those cross-border flows are very important for investment to continue, and that's going to happen more and more through the securities market and through, as Ron says, direct investment. And we need to get that balance right, because I think if we wait for the banks to come back on that, we're going to be waiting a very long time.
Jim?
Yeah, the phrase central banks are printing money is one of the phrases I find most irritating when commentators use it, because central banks don't print money. What central banks can do by bond purchases and by easy monetary policies is create monetary base. You only get money supply once somebody lends it, whether it's through the securities market that David was talking about or through the banks. The conditions for inflation are not there. Central banks have not created them because they would need to spur a growth in money supply, which, as Tracy said, has not happened. I think many people in the market are just confusing monetary base and monetary supply.
So does that mean that we're essentially faced with a paradox right now of a lot of savings but not enough investment, essentially?
I mean, I would definitely say that we're in for a prolonged period where there will be a lack of demand, and we do have more money, particularly at these levels of rates, chasing better ideas. But it's not, again, unusual to come out of one of these huge deleveraging cycles, and I'd say we're probably maybe halfway through it, to see that you have demand that is very, very latent for quite a long period of time.
I would see this rather differently, and I'd say that the savings, yes, they're demographic. There are a lot of savings in the world, but the need for capital investment to keep even the real growth going is very muted. I'll give you an example. We're sitting here in a Hilton hotel. Hilton worldwide has 700,000 rooms. They've spent many billions of dollars through them and their partners building those, investing, huge amount of capital. Airbnb in no time at all has 50% more rooms, and it's done so without the capital investment by bringing idle capital into economic activity. My point here is technology has made capital investment very much more effective than it used to be, which means we don't need so much capital investment for the activity levels that are present. I see it that way much more than as a shortfall in demand.
Nouriel, I'd love to get your thoughts on how exactly we do tap these untapped pools of capital that seem to be growing larger.
Well, I mean, the paradox we have in the global economy is there is plenty of savings. People refer to it as a global savings glut. But we don't have enough demand, especially capital spending. I mean, it's a paradox because most firms are flush with cash, are flush with profits. I think because of shareholder pressure, are giving it back to the shareholders through buybacks, through dividends, and so on. But more than a global savings glut, today we have a global investment slump. Investment as a share of GDP globally fell during and after the financial crisis, and since then has not recovered. And that's why we have the new mediocre or the new normal of weak economic growth globally. And of course, one of the consequences of this slowdown of capital flows is that global current account imbalances have been shrinking after the global financial crisis. Those who were overspenders and undersavers had to spend less and save more because there was a sudden stop of capital. The oversavers have not spent more and saved less. And the collapse of commodity prices also led to reduction of current account deficit. So some of the reduction of capital flows is driven by the smaller current account imbalances globally. But I think we have to try to understand why investment is so low, because unless there is a pickup in capex and investment, we're not going to see the cross-border flows we've seen before. So I think the two are related to each other.
Hilda, is it all up to the asset managers on this front, or can banks ever play a role even as conduits of capital rather than players that actually extend it into the system?
Everyone plays a role, including retail investors. And one of the most ignored phenomena that has occurred since the 2007, 2008 crisis, liquidity crisis, has been the correlation between equities and bonds. The world has been teetering between recession and slow growth. And in that kind of an environment, bonds have become the hedge, the ultimate hedge. So look at the correlation of equities and bonds. Over the past 30, 40 years, it's been between 0.2 and 0.6. In the last 9, 10 years, it's been minus 0.4 to minus 0.6. I think there is a fault line appearing there. First of all, it explains why savers and investors are putting so much money in bonds. Both savers and investors are putting money into what are very low yielding, negative yielding securities with very poor prospects for returns looking forward. Why are they doing that? Because it's become a very attractive hedge. Because the value of that security is much more than it would appear to be looking at just the yields. So the real question is, how long can that last and how quickly can it revert to normal? And that's where you go into what can happen next. Where will the flows go? Things seem to be in an awkward equilibrium right now. Equities bonds and bank deposits are about a third of the total investment pool, which is exactly what they have been for the last 25 years. If you look at the growth of investable assets, they've grown from 50 trillion 25 years ago to 360 trillion as of 2015. If you look at GDP, it has actually grown from 23 trillion 25 years ago. This is global GDP, and it is in 2015 dollars, normalized to 2015 dollars. It's gone now to 76 trillion. So things are not that out of whack. Yes, financial assets have grown more than GDP, five times. GDP has grown 3 times. But it's all in significant equilibrium, scary equilibrium, particularly given the macro-political view.
I really don't see us being in equilibrium. I don't know, I welcome other people's thoughts. I mean, part of the dislocation that you have right now is that there's an enormous amount of money in the equities markets that I would basically call bond money. And what's happened is that as rates have been kept down so low, and people don't have reasons to reach for yield, they're essentially going in for dividends. And in fact, if you look at the PEs of dividend stocks, you'll see that those have done extremely well over the last couple of years. In fact, I would argue that one of the only explanations you can have for our current pricing levels in the equities market, it's not really driven by top-line growth views. It's not really driven by a belief that there'll be increased margins. Most of us think those will be coming down. It's being driven by bond money that's in there for dividends. And I think that's actually not in equilibrium and a somewhat fragile place to be.
Can I offer a slightly different
Now that
explanation?
we're talking search for yield, everyone's really animated. All right, go on, Jim.
A slightly different explanation. I think Hilda made a good point about how bonds are seen much differently to they used to be in an asset allocation. The Federal Reserve met last week. I would be prepared to bet, and we'll see it when the minutes come out, that the main topic of discussion was real GDP is horrible, up 0.5% in the first quarter. But the labor market in the US is behaving as if it's growing at 2.5% or 3%. What's the explanation? The explanation could be that companies have lost it and business is suddenly unproductive, but I don't believe that. I think the explanation is, remember we're talking there about real GDP. I think the implicit inflation adjustment, the GDP deflator, has got horribly confused. And the reason I think it's got horribly confused is technology. And I'll just give you an example. The car you buy now is not the car you bought 10 years ago. It's got all sorts of collision damage stuff that stops it bumping into things. The car you bought 10 years ago was the same as the one you bought 50 years previously. It did not have all that technology that saves money, saves damage, saves the revenue at body shops, which is right down. All those things mean that you get your car a lot cheaper than you used to. But that's not reflected in the way either the CPI or real GDP get calculated. I actually think that because of improvement in product quality, the economy is really underlying growing faster than most economists' suggestions.
Well, a number of economists has looked at this issue because, of course, we have always had mismeasurement given improvement in the quality of products. The question is whether mismeasurement is more severe today than it used to be 10 years ago. And I think the evidence on that one is a bit mixed. So this productivity paradox that we're creating lots of jobs but not much output remains there. I don't think there is still certainty about what's driving it. Measurement error might be part of the story, but it's not all the story. Maybe we're creating lots of jobs that are low value added, low productivity, low wage jobs, and that's why there is malaise. People have jobs, but they don't have the economic opportunities of the past. So that can bridge the gap between what's happening with job creation and with productivity and GDP.
Ron,
Tracy,
can you please thread the needle between your role at State Street and this productivity?
I want to come back to your point, the question you asked, which I'm not sure we've answered, which is, are the banks going to return? And I think the answer is not in the foreseeable future. I mean, if you think about the current regulatory regimen and the reaction to the global financial crisis, it's really, there's one objective function. It's to reduce, if not eliminate, systemic risks.
That's right.
And if you see what's playing out now, You've got the so-called global European banks that are retreating to European shores. Barclays is about to become a high street bank. So I just don't think that you're going to see the banks, certainly in the careers of most of us up here, returning to that kind of role.
I think that's a really good point, Ron. I think we don't see that coming back either, which does bring us back to, I think, the important role of the securities then industry and asset management in providing that intermediation. The other place I think it really calls out for is more and more development of local corporate bond markets around the world.
Correct.
When I have the opportunity to meet with the finance ministers of a lot of emerging economies, my one piece of advice is the development of a pension system and an underlying bond market, because that is what's holding them back, because most of these countries are still very much captured by their own banking system.
Yep.
And if they had this additional source of capital, we would all be stronger.
Indeed, one of the reasons that the United States has done better than most other developed economies since the financial crisis is precisely what David says. It's because we've got developed capital markets. And you know, we see clients all around the world looking for credit-type investments. Where do they get them from? You know, global credit is 70 or 80% the United States. It is about time that finance ministries, central banks around the world were a bit more encouraging of capital markets if they want their economies to grow.
Okay, but given that many of those capital markets are still in development stage, and we also have the retreat of the banks, does that leave asset managers as the more significant providers of capital in the new landscape? I'm going to throw that to Ron. Or Hilda, please.
Yeah, I'll be happy to answer that. They move assets. They don't create assets. The assets to invest come from corporate and institutional and individual investors. And the world, as much as I insist that we are in some kind of an interesting equilibrium in the world, except for the geopolitical risks, which are substantial, is that you've got a large portion of the world that it's in disarray, macroeconomic disarray, the emerging markets right now, led by China. So the reason why you have not seen, so yes, asset managers will move assets around if the assets are there to be moved around. Why have you had such a relatively low capital spending in the United States and in the rest of the world? In the United States, it's because margins have been very strong. Why are margins so strong? Because there have been corporate efficiencies created in the last 40 years. I lost my train of thought. And interest rates have been so low. So you've got huge margins with which to produce profitability and huge spreads on your side with which to produce profitability. And that's why you've been paying high dividends and buying back stock. Will that end? Yes, it will end when the world begins to grow, when we continue to expand, of course, taking into consideration all the technological shifts that are going on, but it will end. You just have to allow the world to enter a new cycle, having completed what Bridgewater calls the beautiful deleveraging that seems to be happening very slowly, but it's happening.
I'm sure
But you know, those high margins, the high margins that Hilda talks about are the other side of Nouriel's slump in capital investment. Because capital investment has become more efficient, the return on capital can be much higher. I'm not sure that goes in reverse. You're right, Hilda, there will be a cycle, but I don't think it goes back to the 80s and the 90s with much less productive capital investment. I think it goes in a different direction, and us baby boomers could be rather too nostalgic for the 80s and 90s if we're not careful.
It might, but we do have a dual economy. We do need infrastructure investment all over the world, specifically in the United States. It's not all high tech.
Yeah, I'm a bit of a heretic on infrastructure, actually.
You're what?
I'm a bit of a heretic on infrastructure.
Go ahead with
Everybody says what you just said. We need lots more infrastructure. If I look at various parts of the world, and I posit, for example, driverless cars, supposing that works within a decade or so, which it might, then the capacity of roads goes up at least 50%. The number of cars on the roads becomes less. Even nowadays, every Uber car, on their estimate, replaces 4 or 5 owned cars. So if you have driverless cars, the use of capital becomes massively more efficient, and you may indeed find that the 405 is no longer a parking lot. It may move quite freely without very much extra work.
So we will not have to rebuild Kennedy Airport.
Kennedy Airport's actually okay. It's LaGuardia I worry about.
Or subways or bridges.
See Jim's jet just outside, did you? Yeah.
With a bar in it. Yeah.
Well, you know,
All right, moving swiftly along from debating the pros and cons of American
I mean,
airports.
many emerging markets are still extremely poor, and with the exception of China, that they overinvested in infrastructures that are still having massive infrastructure needs. I mean, go to India and so on. So I don't think that Uber is going to be a solution to all the infrastructure problems of every emerging market. I think if there is going to be a source of economic growth in many emerging markets, in advanced economy, is going to be public investment, infrastructure projects, private-public partnerships, and ways of funding it. That's going to be the key issue, because this is all long-term investment that requires long-term funding. So we should see plenty of investment in spite of technology.
Yeah, and this goes back then to David's point that that's not going to happen efficiently without the development of capital markets.
Yeah.
Correct.
That's true. No, exactly. But, you know, to give you another example on banking, banks here have enormously expensive branch networks, lots of workers, very, very expensive. A bank in Kenya means your mobile phone. The capital investment, they've skipped the whole stage of bricks and mortar and the retail systems, and you now in many parts of Africa can bank on your mobile phone. I think that would be very hard to achieve here because you have a legacy infrastructure, but I think ultimately it shows the potential of technology to bypass that very capital investment-rich period that we had here.
Well, you need a telecom network that is sophisticated, right?
True.
It's different type of capital, but it's still
True.
capital.
That's a lot cheaper than building lots of bank branches.
All right, I'm sure we could talk about infrastructure investment for another 20 minutes. There is a sentence I never thought I would say. But let's move on to another big topic in the world of capital flows and asset management, which is, of course, the rise of passive investment and how that actually impacts the flow of capital, whether it be cross-border or internally. Ron, you're obviously a big player in this space. I want to get your thoughts first.
Well, I mean, the way I think of the rise of passive investing, it's simply investors and asset owners, what they really want is they want efficient exposures at low cost. And 40, 50 years ago, this innovation was let's take active exposures and figure out what's really the market and beta, if you will, isolate that and deliver it, one, more precisely, and two, at lower cost. And that makes sense for people. What's happening now is what's left over is active. What we've discovered is there's actually other kinds of exposures in there that can be stripped out, delivered very precisely. So in other words, your risk budget is, in fact, the risk budget that you want, and at lower cost. So this is nothing more than saying we're going to take this heterogeneous set of exposures that really weren't very precise, and let's isolate them and deliver them in a more efficient way. But this debate, so I'm going to try and stop it before it starts, quickly turns into an active or passive, and it's just the wrong debate. It's active and passive, because what's left over then is real need. First of all, there's idiosyncratic opportunity, and you need skills to actually participate in that and to get those kinds of returns. So for me, this is nothing more than technology advancing, the ability to deliver more efficient exposures, cheaper, but still a need for high-skilled investing.
Yeah, I agree completely with what Ron has said. If you looked at the typical long-only active manager, 90% of the assets were passively managed. They were just hogging a benchmark with that. And if they were really active, maybe 10% was actively managed. What we are seeing now is a more efficient packaging of the beta, of the market risk, at very low fees. Well, mostly low fees. There are some high fees ETFs there. But and then the hedge funds have come in to deliver the quote-unquote presumed alpha, pure alpha. I don't know if we have not ended up with a combination of cheap beta and expensive alpha, essentially paying the same fees we were paying for long-only managers before. But that's another story. I hope you all investors can figure it out how to really parse the management fee so that you don't end up paying a higher fee with a combination of pure alphas and package betas.
I think
But it's a very good development because it allows investors to have clear choices, relatively clear choices, particularly very clear choices with betas at very low fees and very well diversified.
David, from a more active manager side, I'd love to get your thoughts.
So I very much would agree with the way that Ron has characterized this. I think that in index, and particularly then if we combine that with a vehicle structure and ETFs, and I do think the things are different, but can be packaged for the purpose of this, has been a way of delivering at least equity beta in a cheaper, effective way. And to the extent that that has disintermediated a lot of benchmark hugging active managers, I think that's all to the good. It's what competition should happen, and I think investors have benefited from that. And active managers now must find the areas where they truly add undifferentiated alpha and uncorrelated alpha, and I think that's the role that they should play. So I would agree that it is passive and active, not or, as we go down. To the point about hedge funds, I think one of the things that's happened along the development of hedge funds is that people didn't necessarily know how to disaggregate alpha beyond equity alpha. As we've gotten smarter about attribution models and what really is uncorrelated alpha, we're learning that an awful lot of things in hedge funds actually were levered beta. And I think the next generation of what Ron described will be a set of products which is able to actually deliver those sets of alpha in cheaper ways. And that's one of the things that we've been spending a lot of time and research dollars on.
Jim, would you like to take this opportunity to bash hedge funds a little bit?
Not really. I think it's hard to generalize about hedge funds because there's so much variety in there. There are strategies that are clearly, as David described it, beta for very high prices. There are strategies where pretty good things can happen. And I think the challenge for the ultimate asset owner and their intermediary, their consultants and advisors, is to distinguish between the two, and it's not always easy. On this active-passive argument, though, I actually think hedge funds are a little bit of a sideshow here. It's not that hedge funds are the answer to finding alpha. I agree with the comments about passive that Hilda, Ron, and David have all made, where it affects liquid, large-cap markets. But I think what we're seeing, partly with the change in the financial system, partly with the expansion of capital markets that David was calling for, which has started, you're seeing the growth of less liquid, and therefore by nature less efficient markets. You're also seeing, because of bank regulation, markets that used to behave like public markets now behaving like private markets. And there's a lot of people at this conference in the high yield market. I can tell you that now behaves more like a private market than a public market. If you want to buy a load of bonds, you have to go find them. You can't get them off the book of a bank anymore. So the structure of the market has changed. That is an opportunity for the active manager who can identify opportunities and be opportunistic in a market where liquidity is less. So high yield, real estate, some of the emerging capital markets, those are just great places to be looking if you're an active manager right now.
I agree. And I think one of the great sources of value added will be emerging markets within the next couple of years. They're relatively undervalued. At some point, their currencies will stop falling. And the valuations will be low enough that even given their macroeconomic risks and this low growth around the world, they're still offering very attractive potential investment returns.
I promise we are going to come back to the liquidity issue in a few minutes. But just before we move on, I want to address something that Hilda brought up early in the conversation about correlations. And one thing that has often been blamed for rising correlation, other than central bank liquidity in recent years, is the idea of passive management and everything all moving at once and investors sort of herding into the similar position. Is that a legitimate concern, or has that become a scapegoat? Ron?
A scapegoat.
Oh, well, okay.
Yeah, do you want to start, Hilda? Because I agree.
That's it. Clear.
It is a scapegoat. I mean, I've heard this herding argument before. Regulators have made it, and they'll talk about it in the context of large mutual funds. But assuming that there's, behind a large mutual fund, are individual investors that want to be in the asset class. So if the vehicle weren't there, presumably all the individuals would be doing the same thing. So I don't think a vehicle by itself is actually the cause, whether it's a passive fund or a mutual fund or whatever, is the cause of herding. I mean, part of it is we've got free and instantaneous information flow. That information isn't always accurate, and what's certainly not accurate is the way that people actually act upon it. So you might see, in fact, you do see instances where investors, whether they're individual investors or institutional investors acting on behalf of individuals, are rushing in or rushing out of things. But I don't think that's a function of a particular kind of vehicle or asset structure.
Yeah,
Muriel?
yeah, with that, you pointed out that maybe the behavior of central banks might be driving part of this correlation. We've also seen increasingly for the last few years a number of episodes of risk on and risk off. I mean, we've had already 2 episodes last summer, August and September, where concerns about the hard landing of China led to a global risk-off episode. Another one in January, February was not just China, it was China, US growth, the Fed, the global banks, emerging markets, oil prices, you name it. So I think that increasingly we live in a world in which macro factors matter for one reason or another, and sometimes even small economies like a small Greece, and the risk of Brexit can lead, like spring of last year, to risk-off, and that's where the drivers of some of those high correlations. And as long as those macro drivers are going to be there, we're going to see more of these phenomena in which there are periods of time where risk is on or off, and many asset classes are highly correlated with each other.
Tracy, what has happened is the technology has enabled faster movement. So for sure, with the rise of ETFs, it's a lot easier to put risk on or put risk off before, and that's what a lot of investors do. They'll put it on quickly or take it off quickly, and then make active decisions after that. So if your point is the technology made it easier for this to happen, that's probably true. But it's not a cause of herding in my mind.
But remember that this risk-on, risk-off environment is a state of the world that can shift very quickly to the types of risks that you're trying to fend against. And what we're now trying to manage is, are we veering towards recession again, or are we moving on to slow but certain growth? I think there will be a point in time in which the risks that we are managing against are going to be very different. At some point, we're going to be managing against unexpected inflation rates. It's not a high probability scenario, but it is there. What can cause it? An interruption in trade flows, a war, risk of macroeconomic shock, protectionist policies in the United States if someone like Trump wins, and we should not mention names. But there are different sorts of risks that we will be morphing into, which are not stocks versus bonds. And that will create a completely different state of the world.
To Hilda's point, Jim, we did see ruptions in emerging markets earlier this year, to put it mildly.
Last year, as well.
Last year as well. Were those caused by capital flight or something else?
My belief in the emerging market semi-meltdown that happened last year is that it was driven by deteriorating prospects for those emerging markets, primarily because of over-indebtedness. Just look at the debt levels of the economy in China and Brazil. They've both got to levels where the debt cannot rise indefinitely from the current level, and the creation of growth through credit growth is not sustainable. You also had, and this doesn't affect China in the same way, but for other emerging markets, you had the bubble bursting in commodities. So you had those phenomena going on at a time when the Federal Reserve was slightly on the tightening side, not dramatically, but slightly. And that, the capital outflows, though I would suggest, didn't really happen because of the Fed. I believe they happened because of the deteriorating prospects for those economies. I continue to be a firm believer from a lot of time in markets that capital seeks high returns, and when prospects are diminished, capital is withdrawn.
If If I could add, I think that the emerging markets had a great decade between 2003 and 2013, and since 2013 we're seeing a weakness of both economic growth and asset prices. I think there were three global tailwinds that became headwinds. China used to grow 10%, now it's growing barely 5-6. The commodity super cycle is over, and however slowly the Fed stopped QE and started exiting zero policy rates. So these have become, first of all, headwinds that are eating emerging markets. And in the boom years, of course, money was flowing cheaply to EM. You had loose monetary policy, loose fiscal policy, loose credit policy, twin current account and fiscal deficits, rising inflation, falling growth, build-up of debt, some in domestic currency, some of it in foreign currency. And many of these emerging markets moved away from market-oriented reforms towards models of growth based on state capitalism, state-owned enterprises, state-owned banks, protectionism, resource nationalism, you name it. And now we see the consequences of that. And now the global headwinds are hitting them, and those who are fragile are becoming more fragile. I mean, the good news is that compared to the past, where you had severe financial crisis in emerging markets, with some exception, we have not seen them because they learned lessons of the past. They had less liability dollarization, they built up a war chest of reserves, they had more flexible exchange rates, so shocks have occurred, but they've not led to the same kind of banking, corporate, sovereign debt crisis that we've seen in the decade of the 90s. So that's an improvement, at least. They're more resilient than they used to be.
But wouldn't you say in some senses that the whole notion of emerging markets as an asset class is a bit outdated? I mean, we went through a period when emerging markets meant these small countries that were trying to grow up. And then we went through a period where they were the BRICS. And you can't imagine a series of countries that look more differently now than the BRICS.
Well, there are some people who would blame benchmarks for that, right? As soon as a country was called emerging market, it got lobbed in with everything else.
And I think we would say one of the issues with benchmarking investments in emerging markets now is that they really haven't caught up to the realities of the ways in which these economies are working. And we have found that actually investing in industries across emerging markets is a much more effective way, in some ways, to what Jim was saying. We've found industries in almost all of these countries which are growing rapidly, need capital, and actually have very strong prospects. And we don't have to invest in the country in order to invest in the middle class in India or the growing need for healthcare in China. And that is a much better way of looking at the whole problem than going back to the benchmark view of emerging markets.
Yeah, and in support of that point, if you look at these emerging markets benchmarks, many of them have state-owned enterprises in them. So you've got to have a view on state-owned enterprises if you're going to be just investing in the index or hugging the benchmark.
All right, I want to go back to a point that Jim made earlier, which is that even though we've seen in some senses a lot of liquidity flood the system in the aftermath of the financial crisis, a lot of markets are acting as if they are private markets. We continuously hear about illiquid fixed income specifically. How do we explain that disconnect?
Yeah, I think that there are 3 or 4 things going on together which mean that markets which used to be shock absorbers are now amplifiers. There is a very big difference now between how markets behave to stimulus compared with 10, 15, 20 years ago. Part of it is the withdrawal of bank capital from securities trading since the financial crisis because of the regulatory and other issues that we talked about earlier. Part of it has to be put back to something called Reg NMS, which was the introduction of multiple trading venues and market makers within the US equity market. That led to the phenomenon of arbitrage between those trading venues, leading to a lot of front running, as described in the infamous book by Michael Lewis, that I'm sure some people here think is nonsense, but I actually think is about 80% accurate. So you have the tendency to front run, which I think has become much more ingrained in markets, particularly trading funds. And then, not to go on too long, I hope, but the behavior of ETF investors. There is nothing wrong with ETFs, but there are a lot of financial advisors, particularly in the United States, who say, oh, sure, you can go into equities and I'll get you out when the market starts falling. They put in market stop-loss selling orders. Those are actually what made the flash crash so bad. Those are the reason why, at times last year, you had quite big ETFs trading 15 or 20% away from the mark-to-market on the underlying collateral. Those are fundamentally destabilizing behaviors. And then lastly, leverage and short ETFs. Those lead to orders to close at the end of the market day, which amplify the movement that's happened so far. When you add this all together, what you should really on fundamentals lead to a 2% move in markets regularly leads to 10. It happened in January and February of this year. It happened twice last year. It's happened several times. The only answer I have to that is get used to it and exploit it.
But I suppose the corollary, or what regulators would trot out as a defense, is the idea that even though we get more mini shocks in the system, we are in some senses insulated from a big systemic event, such as, say, a Lehman Brothers. Nouriel, I know you have strong opinions on this topic in particular.
Well, we live in this paradox that Jim pointed out. On one side, we have massive amounts of macro liquidity, because ECB, BOJ, Fed have double, triple, quadruple base money. So at the macro side, there is a flood of liquidity, but now, in part because of regulation and the point that Jim has made, there is a micro illiquidity. And it's also exacerbated, in my view, by the fact that most of the issuance of instrument security in the last few years have been fixed income debt instruments, both private and public sector. Most of them now increasingly are being held by a variety of whether ETF or dedicated credit funds or asset managers that on the asset side, we know these are over-the-counter instruments, most of them. They're relatively illiquid, and you can exit essentially overnight from these instruments. So there is a new form of a currency mismatch that is created. In normal time, it doesn't matter when you have sudden situation in which a macro shock occurs and then people want to redeem, then there is this currency mismatch, and that's why now part of the logic is to try to figure out how you can provide buffers of liquidity for some of these asset management or gating or other ways of avoiding a situation which you could have a fire sale. So it's an issue that we have to address. The regulator will tell you, yes, the system is less leveraged, there's more liquidity, there's more capital. Yes, there are less market makers, but we're making the system more stable. But the paradox is that you might be creating more short-term volatility as a consequence of that. And there is not an easy trade-off between those two goals.
Yeah,
So how does, oh, please.
Well, I would just add to this that the regulation really hasn't caught up with the technology here. So if you think about what happened back in August with ETFs, in addition to the things that Jim described, I mean, you had the limit down, limit up. That was those rules were put in place to basically dampen the volatility of individual stocks. What was happening during that? If you're again, an ETF gets treated like an equity stock, like an equity issue then. So you had the ETF market actually trying to catch up at that day, but was being, in essence, held down. As price discovery actually was established that day, you had these rules that were being imposed, conceived for individual securities, now holding the ETF market back. So I don't know that this is a crisis so much as that regulators and the industry need to get together, and I think they are actually saying there's really, you know, there are days now where 40% of the volume is ETF related, right? We probably need to do something different to accommodate that.
The SEC are conscious of this, but they have been, on congressional directions, completely bogged down with the rules coming after Dodd-Frank. So I'm confident that they will get on to what you describe, Ron, once Congress stop bugging them about the Dodd-Frank regulations. But they just don't have the bandwidth to do it right now because of those other concerns.
But also that kind of an environment in which most of the trade is ETF in any single day, that's an environment in which companies buying back their own stock can actually serve to balance the supply and demand, and they do serve that purpose. I think when you're looking at systemic risks that could create a problem in the financial markets, similar to what we had to face in terms of the issues that it gave rise to in 2008, you're going to have to look at some exogenous shocks right now. And one of the exogenous shocks that I worry about, it's a low probability event, but it could have devastating consequences, would be a cyber attack on custodial banks. because the custody area is one in which you find high concentration. And high concentration of assets is always a source of large systemic risk. I don't know the answer to that. Someone I was having breakfast with yesterday suggested that blockchain technology could solve that problem by creating a parallel way of tracking the ownership of securities. But just imagine that there would be a systemic cyber attack on the 4 or 5 largest custodial banks. The only ones that would not be necessarily affected directly by that would be the private equity holders. But all the hedge funds and all the ETFs and all the long-only managers could find themselves not being able to trade because you would not have a clearing agent being able to certify that the assets you own. So there are ways of solving that problem, but I don't think we are paying sufficient attention to parallel tracks that we could develop that might require opening credit lines so that you could trade on the basis, a certain amount of your assets on the basis of what you last were certified by a custody bank. But that, I think, is a systemic risk that we're not looking into, and it's worth looking into.
Yeah, I think maybe just to take that example to a higher level, I mean, what you've seen over the last 10 years is a dramatic rise in the economic activity and rent of the asset management business at the expense of the sell side. And that's happened whether or not it's in research, it's happened whether it's in liquidity, it's happened whether or not it's in the level and quality of the portfolio and trading that all of us need to invest in. I would say with that maturation of the asset management industry goes, I think, a deep responsibility. And that responsibility is that there's a series of risks where, as a relatively small craft set of businesses, we didn't have to deal with as much, which we really do now. I think liquidity falls into that. So we've started really running our own liquidity stress tests on our funds and managing money a little bit differently for that. We're spending a lot of time on cybersecurity. And I will say, I think it's one of the things, and this happened in banking, which will drive a little bit of the large getting larger, because the cost of all of this, of being safer, which is important to do, but does actually raise the barrier to entry for asset management more broadly. And so I think you'll see a continued rise of asset management at the expense of the sell side.
Well, so on that note, if we agree that the balance of power has shifted somewhat from the dealer banks to the asset managers, what behavioral changes are we going to see, especially on the trading side? Are they going to become price makers instead of price takers? What can we expect? Ron?
Well, I mean, you're seeing it already in the sense that large asset management firms, if you look at their trading desks, they're the most sophisticated in the world. And they're accessing all markets, they're using all different venues. In some cases, they're doing direct access to markets. So I think you'll just see a rising level of sophistication.
Yeah. There are 2 types of asset managers, to keep it simple. There are the value managers who look for cheap assets, and there are the momentum players. And between the two, the ones that have the capacity to destabilize the system the most are the momentum players.
Sure.
They can create a herd at some point, they can crowd trade, they can leverage, and when if there is a fire in the theater, they're the first ones to try to get out. Okay? When I look at the marketplace right now, there is kind of a balancing act. Even in the ETFs, in the index funds, there used to be essentially most indices were momentum players because they were market-weighted indices. Right now, there is sufficient, quote-unquote, smart beta, constantly rebalanced portfolios that are creating an equilibrium between the value and the momentum player. So even there, I see kind of a beautiful equilibrium, fragile, but it's there.
I think some people would disagree. They would say in the environment of very low returns and overstretched valuation, we have seen a lot of value investors essentially morph into momentum people who are chasing inflows rather than actual fundamentals. Would anyone care to take that side of the argument, other than me?
I haven't seen that, but I keep on finding very good price-sensitive managers. So
yeah,
Tracy,
but I think the counter to that, Tracy, is that when the power was all with the dealer banks, there were not very many of them. It was very concentrated on a small number of bulge bracket firms. Now that things have moved a bit more to asset management. I'd hesitate to describe asset managers as powerful because we're agents for our clients ultimately. The asset owners are ultimately more powerful. But both the asset owners and the asset managers are extremely fragmented industries, which actually I think helps your momentum point. And I think that that is actually a very important characteristic. Even an asset manager like Ron with over 2 trillion under management, that is not a big proportion of the global industry. And I think that that's a source of some satisfaction, or at least some confidence to me, that we still have a lot of decision makers out there.
Ron, to Jim's point, we were talking earlier about the idea of the asset manager mingling with the idea of the asset owner.
Yeah, well, could I address Jim's point first? Yeah, because I'd like to emphasize something that Jim said. We've talked at the beginning about banks, now we're talking about asset managers. If you think about banks and the concentration, and when banks get large, that is a concentration of risk. Asset management, we act as agents for others, we're a distributor of risk. You then add on to that this fragmented nature of the industry. So this idea that somehow as asset managers get large or more pervasive, that we're somehow going to see the same kind of thing that we saw in 07, 08 as it related to banks, I just don't think the analogy holds.
I agree with that. There is no concentration of balance sheet risk. I do think there's concentration of some of the other types of risks we've talked about. So I think there's a little bit of a liquidity risk concentration, particularly in retail structures, and maybe even some cyber risk that you raised. But the classic sense, particularly which the FSOC and others look at, we actually, I would say, are a distributor of risk.
All right. Before we move on, I want to ask an existential question for the asset managers on the panel. In this environment of low returns, where we've just spent a good 60 minutes talking about risks in the system, overstretched valuations versus momentum trading, is there a need for investors to ratchet down their return expectations?
Absolutely.
Please.
But to normal. You should not be expecting any high returns from bonds. You should be expecting reasonably normal return for equities, meaning 6 to 7%. That's what's normal. That's what capital markets are likely to give you over the long run, with an 18%, 17% volatility around the equity return. That's big volatility for the level of return. That's normal. Yes, investors got pampered by extraordinarily strong security markets that gave them extraordinarily strong returns. And that is not likely to be the future. That is the good working assumption to have. Yeah. And the real question is, will they be paying an active manager fee for that? Yeah, they will be paying a passive management fee. And I think there is a role for fintech. There are all kinds of robotic investing, and I think we'll see them in 2 configurations, momentum and price sensitive. And investors will have the choice. Millennials are flocking to that kind of the disintermediation of the investment management function.
Going back to your question, Tracy, my answer is yes. If I'm right about the deflationary and efficiency increasing impact of technology, then the current just under 2% on the 10-year yield might turn out to be fairly typical of the next decade or 2. Now, you can't foretell the future, but structurally, I think that would be not surprising. And if I look at almost every period in economic history, except the period between about 1965 and 2005, every period other than that, 2 or 3% yields are pretty common. And they last for decades sometimes.
Yeah, well, they've lasted in Japan for decades.
Yeah, and
so it's not unlikely that it could happen here. Yeah.
So if you have a 2% risk-free rate, which the 10-year yield is the risk-free rate, then what's an equity risk premium? That takes your equities to 4, 5, 6% maximum.
Exactly.
And long-term, I don't think that is a bad outturn. But it just seems to me like the most likely planning scenario. And that has all sorts of implications. Hilda mentioned fees. 2 and 20 dies in that circumstance, completely. You end up with beta becoming really cheap. And the biggest price erosion right now is actually in passive, where fees are really coming down very sharply. In active, where there is any evidence of alpha, fees are much more resilient, but they still need to be modest against perhaps some of the past practices.
Thank you.
But this world of very low bond yields, what are the implications? You have bond yields are low and actually becoming negative for what, $6 trillion equivalent of bonds between Europe and Japan. You have 10-year treasuries in Japan being negative 10 basis points, even less than in Switzerland. What happens to insurance companies? What happens to pension funds? What happens to all those institutions that have a mismatch between the return on the assets and the liabilities? How do they survive in this world?
Yeah, at the moment, the insurance companies and central banks of those countries are big buyers of US securities because there's still a positive return. Now, that obviously can't go on forever. But that's what's happening right now. I would argue, though, that negative rates are a consequence of really bad government policy. The US got out of the Great Recession by easy monetary policy, a period of easy fiscal policy, some really thoughtful structural reform, including recapitalizing the banks. The rest of the world only did the first of those. They forgot about the easy fiscal policy. They forgot about the structural reform. Is anyone really surprised that they're underperforming? I think it's bad government policy that's led to negative rates.
But
David,
if you believe in your
Tracy,
world
if
in
I
which
could add to the,
technology, if you live in a world in which technology is going to imply deflationary pressures, then even achieving 2% inflation becomes hard.
Yep.
And then you're going to hit the zero bound every time there is a recession over and over again. And once you hit the zero bound, either you do QE or you go into negative policy rates and all sorts of policies that damage the financial system. So what's the solution to that problem then?
Well, David,
Should we change our inflation target? Or should we accept that zero is the new normal for the target for inflation?
Yeah, I think the argument of inflation targeting is a nostalgic argument for the 80s and 90s. I think the central banks will not manage to get to the inflation targets they're describing, but we shall see. And I think in those circumstances, you try and keep the economy going in a positive way. The policy mix becomes very important.
But in a world in which there's a lot of debt, deflation has a Fiduciary and debt deflation effect. That is what central banks worry about as well.
Yeah,
so
absolutely.
Going to zero as your target is not easy either.
No, it's
You
not.
know, I want to comment on the low return environment, whether it's 3 to 5% in stocks or 4 to 6% in stocks or 2 to 3% in bonds. In that kind of an environment, we are likely, with a lot of external macro-political shocks, you're likely to see very high volatility. So low returns, high volatility.
It's true.
And who knows what the correlation will look like in that kind of an environment. Maybe it will continue to be negative between stocks and bonds. But in that kind of environment, then I would make an argument that the ability to add alpha through active management becomes a lot more relevant.
Yeah.
If it is credible and if it is significant.
True.
And it's an ideal environment for active management.
That's right.
David,
If the clients accept that you're going to deliver a high information ratio in your alpha. But
David, it's easier to sit up here and say, in the current environment of low yields, negative rates, investors should be ratcheting down their return expectations. But at the same time, we do have a reality. We have pension funds that certainly have relied on higher than 6 or 7% in recent years to fill the funding gap.
We absolutely do, and I know many people in the audience live this every day. It is very difficult to go to your board and argue that the actual expected return on the portfolio should be lower. That said, I believe we think that is absolutely the right and responsible thing to do at the moment, for all the reasons that you heard up here, and we would actually be even slightly lower maybe than what Jim described. We think that the responsible answer is not to try to shoot for the right long-term returns. Those will be lower because of the deleveraging environment that we're in. If you were to look out and say, what could drive bad behavior or bubble behavior in the environment we're in, I would say it's unrealistic expectations, because that's what's driving huge amounts of money into alternatives, which are somewhat vaguely described, that are promising yields and that have a lot of leverage, because people need to find something that will square the circle to their 8 or 9%. And that is very risky behavior in my book. And we certainly find as fiduciaries, one of the main roles that we're playing now is to tell clients that we don't think that their returns are reasonable, or that we can't manufacture a product responsibly that meets some of the risk return requests that they make.
Tracy, this is a really important issue, because if return expectations really should be ratcheted down, for a pension fund, you only have two levers. You're either not going to pay as much as you promised, or you're going to save more. And saving more for many pension funds, a public pension fund, means higher taxes. Or you're going to say to your beneficiaries, I know we promised you X, but we're going to give you 0.8X. So resolving this quickly, because this is not a problem that's going to get better over time.
Yeah.
It's one of these problems that's fairly easy to kick down the road, but it will not get better over time.
No, and I think if we take a little bit of a playbook out of what's happened in the UK, the notion of moving some of this risk off the balance sheet of corporations and onto the balance sheet of insurance companies, which is we're actually much better at matching the long-term liabilities of this, whether or not it's through liability swaps or actually a pension risk transfer initiative where an insurance company will literally take the entire liabilities off the balance sheet. I think we're headed down to more and more of these kinds of solutions for exactly the reasons Ron mentioned.
Yeah, and the problem with that's the public funds.
Yes, that's a corporate
Public funds have a
solution.
different issue.
Absolutely.
And those are inefficient solutions, because insurers are very expensive, protected ways of managing assets. They're not competitive enough.
All right, we only have a few minutes left. I want to go back to the premise or the starting point of what has been a very varied conversation, which was, of course, capital flows. There have been some who have suggested that we currently face an inflection point in cross-border capital. Do we return to a balkanized system that's mostly domestically driven, or do we reform the system, develop some of those capital markets that you were talking about, Jim, and have a more stable but still free-flowing system of cross-border flows? Where do we stand on that topic? Jim, I'll start with you.
Yeah, free movement of capital is very linked to trade. And what happens to trade is unfortunately very linked to politics. Sitting here in a year's time, we could have Britain and Remain and President Clinton. That would be status quo. You may not like it, but not much would change. We could have Brexit and President Trump, both very antagonistic to trade.
Correct.
That would tend to reduce cash flow, that would tend to reduce capital flows. So I think it's much more a matter of political risk than it is we are at a point where it cyclically will go down. I think capital flows across borders have had a kind of golden era of being very free. And I think if we want prosperity to continue, we got to hope that they stay free.
Nouriel, I know we were talking about political risk earlier in this exact issue.
Yeah, I mean, we already have seen in the Eurozone a process of balkanization of the financial system, especially at the peak of the concerns about the Eurozone crisis, where cross-border exposure to bonds of sovereign was significantly reduced. I think the scenario will be one that leads to that balkanization. It starts with Brexit. If Brexit occurs, maybe the next day the Scots say, we want to leave the United Kingdom. The next day, the Catalans say, we want to leave Spain. The next day, the Nordic members of the European Union say, without the UK, what's in for us? Because Europe is becoming mostly the Eurozone for the Swedes, for the Danish. And if on top of Brexit, you get also Grexit, something you cannot totally rule out, then you have the beginning also of the end of the Eurozone. So I would say there's a wide range of risk. I mean, also the risk of a collapse of the Schengen agreement might imply restriction to mobility, not just in goods and services, but also labor within the European Union. So those are the kind of political risks that might lead to restriction also to capital movements over time. We've already seen a backlash against capital flows, right? Resource nationalism, restriction to foreign direct investment, China imposing capital controls, and so on and so on. And we may be in a world in which there'll be more restrictions to capital flows.
I think the point here is that everybody's making is that the big change and the concern that everybody had was with banks reconstituted, would that be the impairment to capital flows? And I don't think that's the obstacle. I think the obstacles are political. Between asset managers, the power of asset owners, technology, we can replace the role that banks played. But to the extent to which the political systems or the laws, regulations coming out of that are going to restrict capital flow, that's our risk.
Yeah, that's what I was referring to, as the financial markets being in some kind of a strange, unstable, but equilibrium nonetheless, and therefore a lot more vulnerable to exogenous shocks. And the political shocks could be enormous. Maybe we get lucky and we don't have to face them. Maybe we continue kicking the political can down the road, but that is a real risk that we're confronting.
David, congratulations, you get the last word.
So I would say that my 3 hours, if we look at the 10-year out view, one would be that the asset management industry has taken its real fiduciary duties seriously and has expanded out to take the role that the banks have kind of left behind. Secondly, I do think we need major development of local capital markets to balance out those flows so that countries are not solely dependent on international flows. And the third is we need major leadership in reforming some of our large political multinational institutions, the IMF and the World Bank being the two I would mention here. They have really important roles to play in making all of this happen. The United States has not been particularly supportive of that, and we need to find ways to change their charters and mandates in ways that they can be more effective at what they need to do. Those are my three.
All right, the age of asset management is just beginning, but this panel is now ending.
Good.
Please thank our panelists for their very strong opinions and their ability to segue seamlessly from 2 and 20 to Donald Trump, to blockchain, to robo-advisors, to capital controls, negative rates, and everything else. Thank you so much.
Thank you, Tracy. Well done.